managers love this type of volatility and these market conditions because that's where they make the money. Now they don't go up that much when the market just straight up, where everybody puts in $10 and everybody makes a lot of money. But in times like this, that's a perfect scenario. Times like this, this is going to happen in all markets, and that's when it's good to have the alternatives in the right portfolio.
Wake up, it's time to rise. Talking money with sharp insight. Jim and Ryan here to guide. Mastering the money ride. Saving stacks and planning dreams. Living large by honest means. Tune in now for the schemes. Breaking down financial themes. Money mindset every day. Mastering.
Well, I'd like to welcome everyone to the Money Mindset and Mastery podcast. I'm your host, Jim. Joining me today on this lovely tariff market volatility day, Ryan Genoe. Ryan, how are you today?
I'm good. I saw you laughing. I think you're laughing at my cup, which says the world needs more Canada, which in these situations, I think it really does. So it's appropriate that I'm drinking from that cup today. So
You're right.
And not seeing your mug.
What this mug over here?
Yeah, literally.
Or this mug, yeah. Alrighty. Well, unfortunately, there's someone who has to watch or see both of our mugs today, and that's our portfolio manager of TVH Wealth, Denis Bisson. Denis, thank you for joining us. How are things today?
Things are going well despite the market meltdown a little today. We'll see over the next few days if we recover some of it, but just living through it now.
Well, I was going to say, are you having fun today? Like this is not necessarily unprecedented, but it's not common in terms of these deep losses on a one-day period, correct?
Correct. And okay, you're going to see some losses, 300-400 points, but today you're looking at much bigger losses. The Dow's down 1,600 right now, and it's
wow, that much?
not yet
okay.
4. Oh yeah, and then NASDAQ. On a percentage basis, NASDAQ's down almost 6%.
Really?
Yeah, the S&P are at 475. TSX doing a little better at 3.8, but still big losses all around.
Yeah. Well, the reason why, so the topic today is navigating investment volatility. So perfect day for that. And we're going to talk about some strategies to recover from those losses. Really what we're going to also illustrate later on in the episode is the impact of volatility. So for example, if you're down X amount of percentage points, how much do you need to have in terms of a return to break even the following year? Because a lot of people don't really understand or appreciate that, because we've talked about volatility a lot, but I think today we definitely really want to kind of hammer that point out. Originally, we were going to talk about, let me just see here the topic. It was reframing retirement, embracing longevity, and new opportunities. We might still get into that topic, but I think it kind of goes hand in hand, right? Because if you are someone who is 2 to 5 years away from retirement, and you're potentially experiencing these deep losses in your portfolio, and if they're prolonged for any period of time, that could delay retirement. Or worse yet, if you are retired and your portfolio is down significantly, you could potentially run out of money before you pass on, right? So it's the reason why we want to talk about volatility. So anything else you guys want to add to that from before we get started?
Obviously, it's best just to kind of start digging into it, because obviously a lot of clients, just like we've experienced 2022, 2008, and along the way. And Jim, I know we talk about it as a strategy for a lot of clients, how to make sure they're truly diversifying within a market and how that can really impact them. And this might be a great review for a lot of people to see where they're currently at and whether they're diversified based on what a bank says they should diversify in versus a true diversification of what you're and how to protect yourself when markets have a downturn. So
yeah, and the fact too that because we're going to bring up probably Robo-Advisors as well, and kind of their limited offering in terms of advice during these types of situations, right? So why you'd want to work with an independent advisor, portfolio manager as well, and really some of the differences that we offer to help clients navigate through situations like we are dealing with today. We're not saying that we're going to be dealing with this for sure over the next 3 to 6 months. It could possibly be, but we do know that we have dealt with these types of situations in the past, as recent as 2022, 2020 during COVID. Near the end of 2018, we had something similar, not this deep. 2008, like we can pick times in the past where these situations have happened. Ultimately, we want to show you some strategies to help kind of shelter you from the volatility, but really we want to highlight the impact of volatility. So, Denis, as the portfolio manager, what is volatility?
Well, volatility is when the market swings, and I'm not talking just 0.5%. I'm talking big swings in the market, both up and down. Today, we're obviously experiencing it down. And this is where you really compare what your portfolio looks like versus the market. Is it having the same type of swings? Why is the swing? And the first thing, why are we getting this investment volatility today? Well, with the tariffs being announced by the Trump administration yesterday, a lot of things came into question. How is this going to affect earnings on companies? How is this going to affect inflation? Is it going to be that one time and then a year from now it's going to be out of the 1 year CPI return and that's it? Are interest rates going to be affected? Are they going to cut more? Are they going to actually have to raise? Where's the dollars, the currency is going to go? So there's a lot of things that are uncertain now. We had the same thing during COVID, taking the one that I think most people would remember. That opportunity or that big correction when all these questions I just mentioned could not be answered at the beginning. How long is it going to last? What are earnings going to happen? That was actually a great opportunity to buy, because sooner or later the uncertainty becomes certainty, or at least it becomes clearer where the markets are going and how we're going to deal with things. Now we're at the point where we don't know what's going to happen next. How are other countries going to react? And the more uncertainty, the more volatility, the more swings in the market. They may hear a little noise, markets back up 2%, even though it's down 5-6% today. And then, okay, well, no, that didn't work, back down. So that volatility is going to continue until we get more clarity on what's going on. Already, we know some countries are reaching out to do some negotiation. Even the European leader says we'll hit them back, but we want to see where this goes and have some talks first before escalating, because they know it's a global issue. Vietnam, everybody's moving plants from China to Vietnam, to hopefully make the U.S. happier, and now they're getting hit with high tariffs as well. Are they negotiating? Is that going to last? So some of these tariffs were very high, and you could call them ugly on some of the countries, but are they going to last? We don't know. Is this a negotiating sort of tactic? Potentially, but this is the uncertainty that's following. If it stays, that's when the numbers are going to start being revised on earnings and everything else. And then it'll be certainly a little more certain, but it's going to be a negative reaction.
Yeah, I think some people are thinking that this is more a negotiating tactic. And it seems like that's exactly what's starting to happen. To your point, there are countries now that are coming to the table and they're ready now to renegotiate their agreements with the U.S., right? So it could very well be. I guess what I would like to say to people is this, because right now everyone's in the moment. Everyone's freaking out in the moment, thinking that it's the end of the world and this is going to last forever, right? It's temporary. We just don't know how temporary it's going to be, right?
Yeah.
So I think we need to remind people of that this isn't a forever thing. This is a temporary thing. And quite frankly, some news can come out tonight or tomorrow, and all of a sudden the sentiment will be, hey, this is actually not as bad. And all of a sudden the market shoot up the other way, right?
Yeah. Let's get back in there.
And again, my learnings too, the market is emotional based on human behaviors, right? So that's one of the things that people need to keep in mind as the market goes up and down, as people, whether they go on the side of kind of freaking out, I think you had said, versus let's stay the course. Let's review our plans with your advisor. Let's see if it fits in my short-term or longer-term goals. And I think there's a scene from Ferris Bueller's Day Off that often comes up more not right now. That this is something that the government, the American government in particular, has done on a few occasions. And the scene out of Ferris Bueller's Day Off goes on to say that it just sent the U.S. into further into the economic downturn versus what they believed it would do as far as sparking the government. So, but again, I've been on 2 calls today, and both calls kind of framework the same thing, which is like, we kind of don't know how to react to what's going to happen. We kind of have to like make small little adjustments and see how it. And it's kind of like going to your doctor, I guess. You know, he kind of has to, he or she has to kind of test, how does this medicine kind of feel with your body and react. And it kind of says the same thing about the economy when it comes to everything that you just talked about, to me, with interest rates and things like that. So,
but isn't this a playbook though, Ryan? I mean, every single time we've had some kind of drastic event, and we hear the economists and the specialists, you know, we're in those webinars and we're in those meetings. It's the same thing. It's, we don't know what this is going to look like. We don't know how long this will last. We don't know really how to respond to this. Just kind of make some minor adjustments here or there. Like, that seems to be the playbook every single time we're dealing with these situations, right?
And Warren Buffett has says it many times. When you see other people scared and run away, that's the opportunity to jump in. And Denis, you just mentioned it. This might potentially be an opportunity for people. And say what you will about a certain presidential person that's in power right now, is there's always strategies to everything. And that's what I'm always keeping in mind to all these decisions that are coming. There's something that we are not aware of quite yet, but I know that a lot of these people make a lot of money when it comes to these types of situations of setting markets. And, you know, we saw that more billionaires came out of COVID than any other time in history. So I think it's something to be said of stay the course, or potentially see what your plans are as far as how your current plan meets your short-term or longer-term need, and just having the open conversation and know that one source is not the main source, that you kind of have to field different ideas as we do in our jobs to find out, hey, if everybody's Chicken Little right now saying the sky is falling, okay, you got to find out what the underlying stuff is going on when it comes to that. So, yeah.
Now, you said a couple times, stay the course. And I know we always hear that whenever we're dealing with this type of level of volatility, is advisors keep saying, just stay the course, stay the course. I say stay the course depends on how you're invested. And this is why we're going to talk about volatility, right? Because if you are one of those investors that decided 2 years ago to put all your money into the S&P 500, right, and it's all in that index, I don't think I'm saying to them, stay the course, right? Because of the volatility. We're going to show those numbers and the impact of the volatility. If you're someone who has a properly managed portfolio and you're diversified in 12 different asset classes, I think you can stay the course, right? Because every asset class is going to respond a little bit differently during the current volatility that we're dealing with right now, right? If you have things structured a certain way, for example, we are proponents of having guaranteed income sources. We are proponents of holding some form of insurance policy that pays a dividend, so that way there is no market volatility. So if that's part of your overall strategy, then I would say stay the course, right? But if you're all in Bitcoin, or if you're all in the S&P 500 or whatever else, I think now's the opportunity for you to speak with someone like Denis, portfolio manager, to look at a diversification strategy and not stay the course. Denis, would you agree with that?
Yeah, it really depends on what you're looking for and the risk you're going to take. If something's in Bitcoin, then you better be ready for the wild swings, the volatility on it. Is it going to bounce back? Not only Bitcoin, Apple's down 10% today. So all the big gainers of last year are getting hit the hardest this year. Any fund or ETF that you bought that's loaded with, say, the Magnificent Seven, they're getting hit hard. Even Amazon's down, more of a retail they're down 9%. So a lot of these stocks are being hit and being hit hard. Shopify, our own Canadian tech darling, is down 20% today. So it's a matter of that's volatility. You don't want to see, you barely see any portfolio go up 20% on a year and they're down and that one's down. So that's the diversification you need. You should have the portfolio, especially ones that maybe because they're taking money out, they can't handle the volatility.
Mhm.
Because once you take the money out, it's not there to recover. So that's why the strategies and portfolio management is to have alternatives, have something within the diversification, not only bonds, fixed income, but alternatives as well. So that's what really holds up the portfolios. It just reduces volatility. So if the market ends up 5% down 5% today, well, you may be down 1, 2%, a lot less because some parts of your portfolio are actually going up on a day like today. Some managers love this type of volatility and these market conditions because that's where they make the money. Now they don't go up that much when in the market just straight up, where everybody puts in $10 and everybody makes a lot of money. But in times like this, that's a perfect scenario. Times like this is going to happen in all markets, and that's when it's good to have the alternatives in the right portfolio.
And I know we're going to sound so boring and dry, and I apologize. TVH, tortoise versus hare, that's our philosophy. It really is the slow and steady approach will ultimately win the race. Right, Ryan, you and I had an interview with Hannah Horvath, and that was something that she did. She mentioned as well in our podcast episode where she did her own analysis and studied, and historically speaking, she said slow and steady wins the race. So I am sorry that we are boring when we talk about these strategies. What I would say is we're really boring when people are making 25, 30, 40% in the S&P 500, but we're really comforting when all of a sudden those are deep dives, nose diving, and you have this comfortable, steady approach. People can sleep at night, right, Ryan? Because I mean that's one thing that you have said in working with clients once you moved over to TVH is with our philosophy, how we position our clients with their overall retirement plans and investments, that they tend to sleep at night now, right?
Absolutely. Unless you like restless sleeps, then and you know the internet, the social media has been pretty quiet over the last 4 or 5 days as far as like pushing the strategies of the S&P 500, purchases and the ETFs, and chasing down Teslas and the Magnificent Seven and stuff like that. It's been awfully quiet, and as we've said before, people are often promoting and talking often when they're doing well, but when the market is down, sure as heck, they are in a cave, not talking about anything. But here we are talking about making sure that you find that fine balance that's going to allow you to sleep at night, and making sure that you're talking to your advisor. And
Mm.
for a lot of people that are in regular contact with their advisor, they're probably not calling a lot. They know that they have a goal in mind, and the goal is being met over the longer term. Um, so yeah, it's just a matter of, as you said, stay the course. If you have everything set up right for those people, this is a great opportunity to review the strategy that you were chasing to maybe find a little bit more balance within that, to make sure that you can have a wonderful sleep. So
Yeah. And it's funny enough, yesterday I did an analysis for an existing client. So she has held an insurance policy, a universal life insurance policy with me for over 20 years now, 20, 25 years. And originally, when I set up the policy, her brother, who I'd worked with at Scotiabank, recommended the investment within the universal life policy, which was at the time, so this was in the early 90s, no, late 90s, 100% in the S&P 500 index. Now, her brother's no longer in the picture in kind of making these recommendations for her. So she came to me and said, well, you're now managing the investments. Should I keep the investment that I have that my brother recommended, or should I consider something differently? So I went through the analysis. And the first thing I showed her was the average return of her portfolio. She didn't know she was 100% S&P 500, but I showed her the average return. And she's like, well, those are like fantastic. Like I should probably keep the investment. And I said, well, wait a second. Now let's look at we moved on from the average. I said, now let's look at the annuals over the last 10 years. Again, very good returns. She's like, I don't understand. Like, I've done really, really well. So why would I consider something different? Then I showed her the chart. And I showed her how from 1999 to about 2012, she made nothing. It was flat. All of her growth has been over the last 10 to 12 years. And it's been really good, strong growth. But I also reminded her that there have been other periods in the past with the index where, again, we've had flat periods. So then I showed her a balanced portfolio within the universal life insurance. And I said, okay, 7% average rate of return over the lifetime of the contract. It's not sexy. It's not exciting. However, there's been growth from day one, right? So even when the S&P 500 was flat for 12 years, you were still, your money was still growing over that period of time, right? This is why you need to diversify. Denis, any comments on that?
Yeah, it really, anytime you sit down with a client, you really have to go through what they're used to. I mentioned this before a lot of times, is that nobody really complains when the market's up all the time. It's these periods where you're going to start sitting, why am I down 5% today? Well, you were up quite a bit before. You got to expect what goes up comes down for the most part, or can come down in this case. Will it bounce back? Yes, probably, but you got to be ready for this volatility. And it's in these periods where you really find out what somebody's risk profile is. Now, I've had some clients, we discussed that when we did our annual reviews, what they're invested in. I keep the communication there. I tell them what will protect them from big swings in the market, and they see their portfolio, and it's not having big swings, so they're happy. They realize it's not going
Yeah,
to go straight up. They also
yeah,
realize there can be some negative periods. They just don't want the big negative periods, and I go, this is what the portfolio is set up to do. You're not going to get the 25%, and they're fine with that. As long as they don't get that negative 20%. The S&P 500, obviously, it was down, what was it, 2022, over 20%? So this is what you got to look at. If you're panicking today, then you may not be in the right portfolio. And I spoke to a friend I haven't spoke to in over 10 years today, and he said he had a great year, 19%, but he goes, I think I'm giving most of that back now. I think we're at September, and after today, and maybe even before that.
yeah.
So, yeah.
Well, it's funny because you said it's times like this where people find out what their risk profile is. And I think I'll correct that slightly. It's times like this when they actually determine or realize what their risk profile is, right?
Yeah.
Because like last year, you would have sat down with a client, and I've sat down with clients who their risk profile was aggressive. Well, because everything was going great and the
Yeah.
markets were going well and whatever else. But then they deal with today, and all of a sudden, like, maybe I wasn't as aggressive as I thought that I was. And this is where you really find out what their true risk profile is, right?
Yeah.
And then the danger for the three of us is when the markets again start performing really, really well, it's trying to kind of rein those clients back to say, remember, this is the reason why we put you in this risk profile because of how you reacted to an extreme situation, which will happen again in the future, right? We just don't know when. So if you want to sleep at night when this happens again for a different reason in the future, remember your risk profile. This is probably the right one that you're in at this point, right?
Yeah.
So
Yeah. I even warned a couple clients during the annual review who are in a conservative balance.
yeah,
Last year, a lot of asset classes did well, including the alternatives. So they end up getting just over 10%. I go, don't expect this every year with your conservative profile.
yeah,
This was a
yeah,
year where everything was on track. That could easily change. And here we are that, they're not going to, well, at this point, they're not up 10%. There's still a full year to go. But yeah, you got to be accustomed to, um, a certain for your portfolio to act a certain way during markets. Once that is there, then clients are fine. I don't get phone calls. They're happy.
Yeah. And this is what I'm going to share the chart now to show basically the impact of volatility, and ultimately what you need to. So if you have a certain loss, and you've shared some losses that you mentioned today, what you would need in terms of a rate of return to just break even the following year. Okay. So this is loaded up here. Okay. And I don't know if it's going to come clear or not. What we're going to do is we're going to start from left to right, starting at the lowest negative return. And this is the reason why we say to our clients, diversify into multiple asset classes to avoid the volatility. Whenever I sit down with a client, we talk about risk, right? Because we're trying to determine risk. What I want clarity from them is, what risk are they worried about? Is it loss of their investment capital, or is it volatility risk? Most people will say, well, I'm afraid of losing all my money. Okay, well, if you're invested in a stock or two, there's a greater risk of you losing all your money. But if you're in a diversified portfolio with 12 different asset classes, the odds of you losing 100% of your money is very, very minimal, right? But what can happen is the volatility. So if you take the money out at the wrong time, then you would be potentially triggering a loss. Starting from the left, in the blue column, if an individual had a negative 1% return, in order for them to break even the following year, they would have to have a positive 1.01% return. So not bad, right? Now, if someone has a 5% negative return, in order for them to break even the following year, they would need about a 5.26% rate of return. And Denis, I think this was actually kind of closer to 2022, right, where we had kind of like the Black Swan event, where I believe the balanced mandate at TVH Wealth and Raintree was about negative 4 or 5. Right. So in order for individuals to break even from that, all they needed was a positive 5.25% return. Correct? Okay. Now, the next one is, well, what if you have a 10% loss? Many people who invested in indexes have experienced this over time. You would need to have an 11.11% positive rate of return to break even from that. So far, what we're showing you is, if your negative return from a volatility point of view is -1 to -10, probably within 12 months, it's reasonable to expect that you can break even if you have an equivalent positive rate of return the following year. Now, if we get to the -15, well, now you're going to need about a 17.65% positive return just to break even. And then, Denis, you had mentioned you had a client who had a 20%, or no, there was one. Is it the S&P 500 that's down 20%? I forgot
That
what
was
comment
about
you had
19 point something, yeah, in 2022. Yeah.
Right. So in order for you to break even from that, you'd have to have a 25% rate of return. And that can happen over a 12-month period, a 24-month period. This is where things really become interesting. It's, again, dealing with these deep dives. If your portfolio is down 30%, you would have to have a 42.86% positive rate of return the following year just to break even. So to give you a little bit of perspective here, if you had $100,000 and your $100,000 portfolio dropped down to $70,000, you would need to have a 42.86% rate of return the following year just to bring that 70 up to that 100,000. The chances of that happening now become a little bit slimmer, and you might achieve that rate of return over a 2-year period. It might take a little bit longer, right? But it's not going to rebound necessarily as quickly. And then finally, this is my favorite one, and we experienced this in 2008 for sure. If you had a negative 50% rate of return, so if you're dealing with a couple of indexes and that's it, and you're not well diversified, this is a potential reality. In order for you to break even from that, you would have to have a 100% rate of return just to break even. And Denis, We experienced that during 2008, right?
Yeah, I'm just looking at some numbers now. In 2008, the S&P itself was down over 38%. So those are big losses. Again, as we said before, stay the course. You ended up getting your money back, but it was a tough time because the U.S. was really going through with their banking crisis a lot of uncertainty. To just say, "Oh, I'm going to put my money back. I'm going to hold on," wasn't as easy as it sounds because you really didn't know what was going on at the time on the U.S. side. Canada was a little clearer. We have more bank regulations here. We didn't get hit as hard. The U.S. saw some big name companies go bankrupt, and that's what scared a lot of people.
Yeah, but because of those deep dives, if you recall, anyone who was approaching retirement in 2008, or even if they still had 30 years, it took 5 years for them to break even from that 2008 correction on
Hmm.
average. It took about 5 years, right? Because again, they weren't rebounding at 100% rate of return the following year. It was happening over a period of time. So, again, to put this into perspective, if your $100,000 portfolio all of a sudden goes down to $50,000, first of all, from a psychological point of view, are you going to hold on? Most people would probably bail. So now they've guaranteed their losses. But assuming you don't bail and you're hoping to recover from that loss, you would have to have 100% rate of return for your 50,000 to come back up to $100,000. And that could take some time. Either take some time, or what we've seen from people is they take on additional risk thinking that that's going to do it for them. And if anything, they actually end up with deeper losses, right? But this is volatility. This is what we focus on. This is when we talk about sequence of return risk, because these are the things that we can't plan for. Can you imagine a retiree planning to retire this year, fully invested in the S&P 500, or the what is it, the seven stock? What do they call it again? The famous
Magnificent
seven,
Seven. Yeah.
magnificent seven, right? Right now, I think they're going to be sitting there going, I wonder if I'm going to have to hold off on retiring for a little bit longer as a result of what's happening today, because we don't know how long this is going to last.
Yeah. Yeah.
It will recover. We just don't know when, right?
And
Mhm.
how long it'll take for it to recover is an important piece to think about when it comes to your goals, whether it's short term or long term. And and just a quick side note, this is, we're talking about the returns or the market that was down, 30% or whatever during 2008. But if somebody at a certain period in time could have potentially taken their money out when the market was down 40 or 50%, even though the year as a whole was down. So that's the psychology piece of being able to work with somebody. Again, if you're working with certain institutions and robo-advisors, you're not getting that advice to make sure that you're going to meet a goal that you're potentially, as you said, potentially retiring sometime soon in the near future. So, um,
Well,
yeah,
let's expand. Let's expand on that, because I think this is where I challenge sometimes people who want to go with a robo advisor platform. And again, it's low cost. I understand that. Part of that is because you're essentially using 100% ETFs. But when you're dealing with a situation like today, I challenge those individuals to make a phone call to see if they're going to get some kind of advice to walk them through the situation. Chances are it's going to be, hey, you can chat with us online, right? It'll be difficult to actually get somebody on the phone. It's not impossible, but they're going to only potentially walk you through the situation with your investment portfolio and what you should do. They're not going to look at your overall retirement plan, your overall financial plan. They're not going to sit there and say, okay, well, how does it impact, the goals that we've set out for retirement? How is this going to impact your goals we've set out for purchasing a property? They're just going to be looking at, well, you're in an aggressive portfolio. Maybe you should be in a balanced portfolio, conservative. That's the adjustment that they're going to make. And they're not going to look at the overall big picture, right? That's the challenge you're going to have with the robo advisors. Now, you can go work at the bank. And depending on, we have to clarify this. I think it depends on what level of the bank you're working with, right? If you're working with, the $1 million plus platform, you're dealing with an investment advisor there, different type of advice that you're going to receive. If you're at the branch level and you're dealing with a personal banking officer and you have some mutual funds with them, again, they're going to most likely focus on what should you do with the holdings you have with them. And they might turn around and say, hey, maybe you should retreat into a GIC. Maybe we should go into cash. Maybe we should just change the mutual fund that you're invested in. They're not going to necessarily give you the advice on how does what's happening today impact your retirement goal, because that's just not the process that they walk you through, right? In dealing with an independent advisor like ourselves, an independent portfolio manager, we're not only just focusing on the investment piece, we're looking at what's the long-term impact of that investment that you're holding today, right? So definitely more from a holistic point of view is what we're doing.
Tell me if I'm wrong, and I love that discussion when I am wrong, because I learn from it, is that this is what I saw through the COVID piece, which was clients going into their local institution banks, the bank's recommending, to be safe, let's put it all in GICs. So not only did they take it on the front end because they already lost 20 or 30%, they then locked into a 5-year GIC, and the recovery from COVID was quite quick. They then took it on the back end because the market did so well when it recovered. So not only did they lose the opportunity because their money was locked in, they got poor advice and locked in their money, and then lost it instead of just reviewing what your overall risk tolerance might have been, because the banks just want to lock in your money. That's all that really matters for the most part.
Mm-hmm.
But they did, a lot of people, a lot of clients that I talked to that are now working with us that are slow and steady, not have to worry about the sleepless nights. They're not worrying about these huge swings that are potentially happening with them. And for those clients, I know we could easily have them on our show to talk about what the peace of mind was at the end of the day, and being able to know that, yeah, their goal may have been shifted an extra year or so, but not reversed back 5 or even 10 years, depending on how close to retirement or their goal was. So
yeah. Well, I think you're right. I mean, one of the things that we've definitely looked at and studied is the psychological side of investing and decision making with money. And typically that's what happens. The markets are down, people are freaking out. What do? They pull out when their portfolio has gone down and they retreat into GIC or cash. And then what happens is the markets come back or going back up again. Now there's the lost opportunity cost, because now they're locked into this 5-year GIC at, call it 2%, and they're missing out on a better return on the portfolio, right? And a big part of that is, there's a couple of reasons to it, and I'm going to say this now as a former banker, and Denis, you can either choose to back me up or not on this one. The first one is the banks don't have a problem with selling GICs to people. They actually make a lot of money off of GICs. Do you know how they make money off of GICs? Ryan?
Loaning out the money.
That's exactly it.
Big
right?
Corporations and mortgages.
That's exactly
where
it.
GIC money is.
So, yeah, we're not going to charge you the 2.5% management fee on your mutual fund, but we'll lock you in for 5 years in a GIC that pays you 2%. But I'm now going to take that as the bank and lend it out to somebody out at 5% per year, right? And now I'm making 3 on that money. And oh yeah, by the way, as that person is making their mortgage payment back, I still know that I have your money tied up for 5 years. So now I'm going to readvance that as a credit card at 22%, 24%. And they have the ability of doing that, like multiplying a person's dollar about 7 times over, right? Secondly, Denis, and I don't know where you came from, if you had the same as I did, but the 3 different banking institutions that I worked from had retention targets. So it was better to just say, you know what? You don't like the mutual fund, you're freaked out by it. Instead of putting that in your bank account, let's put it into a GIC, because now it meets the retention target goal that was set out for that employee. So are they making or recommending the best option for you in that situation? Or are they recommending that option because this is what the higher ups told them that they had to do, right, in order to meet certain bonuses and whatever else? So again, I don't blame the employees. This is the higher ups that are basically saying this is what you have to do. There's a lot of pressure, but a big part of it is retention targets that they have as well. Denis, where you came from, did you have to deal with the same thing?
Yes, I wasn't in the bank itself. I was on the asset management side of it, but I experienced that. I sat down with some people. We started chatting, and he just happened to be complaining about not meeting some targets. They want me to sell MasterCard to everybody. They want me to achieve these. They want to take this money. So, the fact that you're not getting mortgage insurance, right away, the one lady sort of laughs. Oh, my boss is going to be mad at me because you're not taking it. Well, I got my own life term insurance. I don't need the mortgage insurance. But she said right away, my boss won't be happy that you didn't take it. So it
Yeah.
really didn't have anything to do with me. It had to do with them getting the insurance quote. So yeah, no, I do agree with you.
Yeah, and just for the record, you didn't work for the same 3 banks that I worked at. This is now 4 banks that we can reference to say this is kind of like a common practice.
Yeah.
So take that for what it's worth. And going to the mortgage insurance, I just ran a quote for someone. They were being charged $80 a month for just the life insurance with their bank mortgage coverage. I ran a quote for them for a 30-year term for $56 a month, right? So what they're offering you is not necessarily the best option for you. And I know some people will then argue and say, well, you guys are independent advisors and portfolio managers. Clearly your incentive is because you're getting some kind of commission or pay, whatever else. Yes and no, we are getting paid, but compensation is the same across the board. It doesn't matter if we place you with firm A, firm B, or firm C. Compensation is the same, right? So ultimately, it is making the best decision or recommendation for you as a client. And ultimately, going back to my conversation with Ryan, when we're looking at it from a holistic point of view, depending on what your needs are at the time, not just from an investment piece, right? Because we transition throughout the years. There's the accumulation stages, there's the decumulation stages, there's estate planning goals, whatever else. So even the type of solutions that we offer will change over the course of our relationship based on what your needs are at that time, right? So me ranting, I get into these little rants once in a while just because people just don't really understand. Like we had a meeting, Denis, you and I, yesterday with a client. We had asked about the daughter and his father about his assets. All his money is sitting at one of the big banks. And remember the question I asked was, who's the beneficiary on his RIF? And he said it was the granddaughter, our client's daughter. And then I asked a question about, well, she's 16 years old, correct? And he's like, yeah. Is there a trustee named for her? I don't know. Why? And then we explained to him why that's a problem if there's no trustee named on the beneficiary who's under the age of 18. Well, he had no idea. You know why? Because the bank never made that recommendation. I'll guarantee you that his father went to the bank and said, I want my granddaughter who's, as my beneficiary. And they're like, okay. And they went ahead and processed it without asking what age, is there a trustee, should we name a trustee? None of that advice was given. This could have been a problem, right? Considering that his father is aging and his health is deteriorating fairly quickly as well, right? So the benefit of working with advisors. So finally, guys, we talked a lot about volatility. We did discuss how one of the ways you could avoid the volatility. So for us, Denis, on the PM side, right, on the portfolios you manage, really, I think at worst in 2022, when the markets were negative double digits, I believe it was down about 5%.
Yeah, the growth actually was down 6, and which wasn't bad given what the benchmarks were doing.
Yeah, but the whole point in that is we want to minimize. This is where the volatility comes in, right? We want to minimize those down years as much as we possibly can, because again, then recovering from those down years isn't as much of a challenge, right? So during a black swan event, if you're balanced and you were down 5, then you know that within 1 year, as long as you're up 5.25%, you would have broken even. If you were in the S&P 500 and you were down 35%, you would have required over a 40% rate of return to break even. That's a lot of swings, one way or the other. So one of the ways to protect yourself is by diversifying in a portfolio, correct?
Yeah, and today's diversification isn't what yesterday's was, where buying different countries and buying bonds, you're fully diversified. Well, no, not anymore. With portfolio management, and a lot of firms have moved to this as well. With portfolio management, you can buy alternatives, things that move outside the public markets. They have a different return. Now, it's up to the portfolio manager to decide how much to allocate to some of the alternatives, but those really minimize. There's no correlation. And by correlation, I mean if you're invested in Europe, they're down 10%. You're invested in the US, they're down 12%. Are you really diversifying? This year is a little different. Obviously, Europe has shown some positive returns, and the U.S. is negative. So that's actually doing a little different. And bonds, after we had a period in 2022 where bonds and equities were going down at the same time, that's no longer happening. So we are seeing some positive on the bond market while we're seeing negative on the equity market, and that's what you want. I know some people like the gold. I do keep some clients do like putting some gold. Gold's a little different than say Bitcoin because it has a history. There's a value to it because it's not just used as a storage value. So that's a little diversification, but just looking at the portfolio management, there's a lot of things. I mentioned to you guys one time one of the funds within our alternative fund is a music royalty business. Constant flow
Yeah.
of income. That's not going to change. People are not going to suddenly turn off their radios. That brings in the constant income coming in. So this is something like you want. You're not going to put, 20% in it, but you do have some of it and some similar funds to that to create that. They call it alternative because it's alternative to the public market. So you
Yeah.
got to have it. You got to look at it that way. Even when you're looking at an enhanced yield, the private credit also just looks at that steady return, hold until maturity type things. Things that are mostly difficult for an individual to buy on their
Mhm.
own. For example, the music royalty. If you're going to buy that on your own, minimum purchase is $1 million.
Yeah.
Well, most clients can't, but within our portfolios, they could have access to it.
Yeah. And so we talked about, Denis, we focused on diversification at the portfolio level and adding alternatives as part of that strategy with TVH Wealth and yourself. Ryan, you and I also, when we layer, or let me step back a bit. When we speak with a client and we put together a retirement or financial plan, the way we tend to layer things are we start off with a base permanent insurance coverage, dividend paying, with no enhancements or anything like that. The reason why we do that is because with the dividend paying whole life insurance policy, there's tax sheltering benefits to it. You are earning a dividend, and once that dividend is earned, it can't be taken away from you. So there's no market correlation. There's no negative return any given year. It's just you keep building that cash value whole life policy. The second layer on top of that Ryan and I usually recommend is to have some form of guaranteed income source. Right now, if you are a teacher or a government worker and you have a really strong public or government funded pension plan, that's enough, right? But most people don't have that. So we do offer programs that offer a guaranteed source of income during retirement, regardless on the volatility and how the stock markets perform. And then we layer the portfolio solution with Denis and also add the alternative strategies with Denis as well within the portfolio. So there's really 4 layers there, right? And what that does is if you're dealing with some volatility and you don't want to tap into that part of your overall portfolio because it's down and you don't want to accelerate those losses by taking money out, well, then you can access money that's sitting in your whole life policy, which is guaranteed, right? knowing that you have this guaranteed source of income in retirement that are covering your fixed expenses, right? You don't have to worry about covering your bills every single month, right? So overall, the way we protect people from dealing with volatility, specifically or especially while you're retired, is by layering their overall portfolios the way I've just explained. So Ryan, can you kind of repeat again just the 4 layers starting from the bottom?
Again, if you assuming that you have a pension, and I was thinking to myself too, with your pensions in a public sector or private sector too, as we know that there's certain retailers currently filing through the bankruptcy piece, so it may be something that we would look at for you.
I've had clients actually with those firms who've already reached out to me to say, hey, I think I might want to move that money out. And my response is, I don't even know if we can at this point, right? So if it's public, it's pretty much guaranteed, because if there's a shortfall, we'll just get taxed to make up the shortfall, right?
Yeah.
But the private sector, people think that it's guaranteed. It's not.
Yeah.
Right?
And it's something for us that we often talk to clients about to keep in mind when it comes to their pensions and layering. So, but yeah, as you said, like, we're often looking at, is there some sort of a guaranteed income source that people have to help cover their costs or expenses within retirement. We're also looking at life insurance strategies to help implement some, or at least fund some of those costs also in retirement, along with whatever RSPs, TFSAs, and the different layers that are accustomed to people, and making sure that, obviously your base expenses are the things that we're focused on, and then to add joy for the rest of retirement for all the other things that you may have in retirement. So, yeah.
Right. So what I would suggest, if you are out there kind of worried about what's going on, really concerned about some of the volatility that you're dealing with, if you're with a robo-advisor and you're dealing with this volatility and you're really concerned about that and are looking maybe for a second opinion, on the portfolio side, Denis, what's a good way for people to reach out to you?
That would be an email, denis@tvhwealth.ca.
Or they can go to tvhwealth.ca, your website, right?
That's right.
Contact you through there. But also, is there a risk assessment that you have integrated into your website? Is that what that is?
Yeah, there is one for if you have a current portfolio and you want to take a look at it, and it goes through a risk assessment, and this is done by a third party. So yeah, they could do that, or just email me and we could go through it together.
Perfect. And then Ryan, I will give out the phone number 647-727-4668. But there are other ways that people can find us, right?
Yep, tvhfinancial.ca. Also email it as financial@tvhgroup.ca. Also find us on any of the social media, Facebook, LinkedIn, TikTok. I'm sure I'm missing one. Instagram. So, yeah.
Yeah. So if you're looking for what we refer to as a chief financial officer, someone who's basically looking at your overall strategy, reach out to us. Just as a reminder as well, as a family office, we do offer mortgage brokerage solutions. So if you have a mortgage that's upcoming for renewal, or you're looking to buy a place, reach out to us. We would be happy to refer you to our partner, John. On the accounting side, it's tax season right now. That's why I don't really call Dave much during this month, because he'll probably bite my head off. But if you're looking for an accountant to do some of your tax returns and you don't have one, then again, reach out to us and we can refer you to our partner, David. And on the legal side, if you're dealing with volatility, if you haven't really looked at your beneficiaries, if you haven't looked at your will or even have a will or power of attorney, then I would suggest you reach out to us and we would refer you to our partner, Sonia at TVH Legal. And then again, finally, from an overall assessment, Ryan, Denis, or myself, we'd be more than happy to speak with you. So, guys, I think that's another one in the books. Denis, famous last words. You said this would be a 10-minute session. We're at 53 minutes right now. So
A
little bit longer than you thought. But yeah, continue on having fun with the markets right now. I'm sure it's going to be like, it's one of the reasons why I don't go to Wonderland anymore. I'm not a fan of roller coasters, and I'm not a fan of roller coasters in my financial plan and my investments. So if you're not a fan of roller coasters, I encourage you to reach out to us. So once again, guys, thank you very much. And until next time, take care.
Take care.
Why is it me? Why am I a guy? I still